Welcome back to Iraqi Dinar Updates, your trusted source for everything related to Iraq's currency, economy, and the forces that shape them. Today, we're diving deep into a topic that has a powerful impact on Iraq's economy and the value of the Iraqi dinar oil. Grab a seat, get comfortable, and stay tuned as we break it all down in a clear, easy-to-understand way. Let's get into it. The story of Iraq's economy can't be told without mentioning oil. For decades, oil has been the backbone of Iraq's financial system. It's more than just a reserve, it's a lifeline. Over 90% of Iraq's revenue comes from oil exports, which means the price of oil on the global market can either lift the country up or drag it down. So, how exactly does oil affect the exchange rate of the Iraqi dinar? To understand that, we first need to look at how currencies are valued. A country's exchange rate reflects its economic strength, trade balance, political stability, and more. For Iraq, oil earnings are central to economic strength. When oil prices are high, Iraq earns more dollars. Those dollars come into the Central Bank of Iraq, boosting its foreign currency reserves. When reserves grow, Iraq can maintain stability, pay debts, import goods, and, importantly, support the value of the dinar. Now here's where it gets interesting. Iraq doesn't float its currency like many other countries. Instead, it uses a fixed or managed exchange rate system. The Central Bank of Iraq plays a very active role in controlling the dinar's value by supplying or withholding US dollars in the currency auctions. When oil prices are high and the government is flush with petrodollars, the central bank can inject more dollars into the market, keeping the dinar stable or even strengthening it. But when oil prices drop, that's when things start to shift. Lower oil prices mean fewer dollars in the central bank's reserves. With fewer dollars to inject into the currency market, the supply tightens. That shortage of dollars can cause the dinar to weaken in the parallel or unofficial market. People start paying more dinars to get their hands on dollars, especially when they want to import goods, travel, or conduct business abroad. This is how oil prices indirectly push the dinar's exchange rate up or down, even when the official rate stays the same. Let's take a real-life example. Back in 2020, when the world was hit by COVID-19 and oil prices collapsed, Iraq's revenue plummeted. The government faced a budget crisis. The central bank responded by devaluing the dinar in December 2020 from 1,190 dinars per dollar to 1,460. That was a big move, and it directly impacted the daily lives of Iraqis. Prices of imported goods rose, and people felt the pressure. It wasn't just a policy decision, it was a response to the oil market. Now flip that scenario. In 2022 and 2023, oil prices recovered. Iraq earned billions more from exports, especially as global demand rebounded. The central bank started to talk about strengthening the dinar again, or at least supporting it with more consistent dollar supply. So the cycle goes, when oil does well, the dinar finds support. When oil struggles, the dinar gets shaky. But oil doesn't just influence how many dollars Iraq has, it also affects investor confidence. When oil prices are high, investors see Iraq as more stable. They expect the government to pay its bills, invest in infrastructure, and improve services. This attracts more interest in Iraq's financial markets and can support the dinar's value. On the other hand, when oil prices fall and the budget is in crisis, investors get nervous. That uncertainty can lead to capital flight or speculative activity, which puts more pressure on the currency. Another key piece of the puzzle is the government budget. Iraq plans its budget based on a projected oil price. If oil sells for more than expected, there's a surplus. If it sells for less, there's a deficit. A budget surplus means the government can afford to keep services running, invest in development, and avoid borrowing. A deficit, however, forces the government to either borrow or cut spending. Both scenarios affect how people perceive the strength of the economy and by extension, the strength of the dinar. Also, let's not forget about public sentiment. When people hear that oil prices are down, they expect tough times ahead. They might rush to buy dollars, fearing that the dinar will lose value. That rush can create extra demand for dollars, again pushing up the exchange rate and the local market. Even if the central bank keeps the official rate stable, the street price tells a different story. And that street price affects everything from the cost of groceries to rent to imported electronics. On the flip side, when oil prices climb and the government reassures people that the economy is on stable footing, trust increases. People feel more confident holding dinars, and the pressure on the exchange rate eases. So in this way, oil impacts not just the technical side of currency markets, but the psychological side too. One thing to keep in mind is that Iraq is working to reduce its dependence on oil. There's talk about economic diversification, agriculture, tourism, industry, all important sectors that could help reduce the economy's sensitivity to oil swings. But for now, oil still rules the game. Until non-oil sectors generate significant revenue and employment, the fate of the dinar will remain closely tied to the global oil market. Now, some might wonder, why doesn't Iraq just float the dinar like other countries and let the market decide the value? Well, the answer is complicated. Floating the dinar would expose it to massive volatility, especially in a country where oil is such a dominant revenue source and political instability still lingers. For now, managing the exchange rate gives the central bank more control at least in the area over inflation and market expectations. Still, the gap between the official and parallel market exchange rates has become a major issue in recent years. Part of this is due to oil price swings, but other factors also play a role, like US dollar regulations, international monitoring, and domestic financial reforms. But oil remains a central player. So, what's the outlook? Well, if oil prices stay strong, Iraq's reserves will continue to grow, and that should help support the dinar. But if global demand falls or oil prices drop sharply again due to geopolitical events, green energy transitions, or global recession, so then the dinar could face new pressures. It's a balancing act, and oil is a tightrope. In summary, oil is not just a product Iraq sells, it's a force that touches every aspect of the country's financial and currency system. High oil prices mean more dollars, stronger reserves, and a more stable dinar. Low oil prices mean tighter budgets, fewer dollars, and more pressure on the exchange rate. For anyone watching the Iraqi dinar, keeping an eye on oil is absolutely essential. Thanks for sticking with us through this deep dive into how oil affects the Iraqi dinar exchange rate. If you found this helpful, don't forget to like the video, subscribe to Iraqi Dinar updates, and hit that bell so you never miss an important analysis. We're here to keep you informed with clear, honest updates about Iraq's financial future. Drop your thoughts in the comments. We'd love to hear what you think about where oil prices and the dinar are headed next. Until next time, stay sharp, stay informed, and stay hopeful.